Hello, everybody. Welcome to the latest episode in our TP Matters podcasts. This is PwC South Africa Transfer Pricing podcast series, where we focus on key TP developments in South Africa. Joining us in today's podcast is William Eastwood, our lead tax partner for ITS, and Cornelia Espos, the director in our TP team. One of the big changes in transfer pricing and tax generally in our lifetime is we're all expected to become architects. We mention about columns and Corinthian columns and Doric columns and pillar 1 and pillar 2. It's all terribly confusing. And we've got pillar 1 coming out with the Mount B. I don't quite know what Mount A is then, but we've now got pillar 2. And what we're going to talk about in this podcast is pillar 2. William, pillar 2, that comes after pillar 1, before pillar 3, what's it all about?
Hopefully there's no pillar 3.
Oh, don't count your chickens yet.
So pillar 2 essentially is an initiative by the OECD to end or limit the use of low tax jurisdictions by multinational companies by effectively ensuring that those multinationals pay a minimum effective corporate tax rate of 15% in all jurisdictions across the globe in which they operate. So it was announced first in December 2021 in conjunction with Pillar 2, which is what you've just spoken about now. Pillar 1, which we're not going to go into for reasons we'll discuss later, effectively seeks to reallocate taxing rights from the substance of a group where it operates to where its customers are. So the two of those together were introduced both as part of the OECD's broader BEPS initiative, the Base Erosion and Profit Shifting Initiative, which is effectively aimed at bringing up to speed the global tax system so it can effectively deal with how multinational groups have started to do business globally.
Okay, so my earlier liberty aside, I mean, this is huge. This is the biggest thing to hit tax for a very long time in international tax. This is the defining stuff of our generation. It's this whole base erosion and profit shifting, the whole BEPS tenet of OECD is culminating, to my mind, in this. It's the big boys in the economic world, the big OECD countries saying, we're sick of these tax havens stealing our lunch. We are going to throw our weight around a bit because we've actually got it. And we're going to say, we are not going to allow you to have a company in a tax haven siphoning off profits and denuding the tax base of larger countries. They've been doing that for a while with the focus on substance, saying you can't just have these very thin companies pulling more and more profits into tax havens. And they've been using transfer pricing in place of effective management, those sort of concepts to reduce that. And now they're going one step further and they're saying, you know what, there needs to be a 15% minimum tax. And if there isn't, then somebody else in the group can get that money. So yeah, it's a huge shift in international tax. And hence it's going to be a big thing for multinational groups to deal with that and take that into account in their planning. Who should be taking note? Who does this apply to?
Yeah, and I think you're right. I mean, the BEPS action points, there were 15 action points, all aimed at broadly the same thing, which we've discussed. But these are kind of a follow-on from those and really are a lot more of importance, I think, than or a lot more far-reaching than the previous action points. Who they apply to. So the good news for Pillar 1 is Pillar 1 only applies to groups with a consolidated turnover of over 20 billion euros. So really only applies to under 100 groups globally. Pillar 2, on the other hand, has a threshold of 750 million euros and therefore applies to a much broader range of groups. We think it'll apply to approximately 1,800 groups around the world. From a South African context, It broadly aligns with the country-by-country reporting thresholds, and we think for South African outbounds that it would apply to sort of 70 or 80 outbound groups.
Okay. So when is it coming in South Africa?
1st of Jan 2024, based on the draft legislation which was released in February this year.
Okay, so that's now. Okay, so you're a multinational. Or either in South African context, you're either an outbound, so a South African multinational group going offshore, or you're an inbound, which is a multinational group headquartered in the US or UK, whatever, and you've got subsidiaries here in South Africa. The big boys in South Africa, obviously the outbounds, so big South African household brand names, they're going offshore, they're the outbounds. What does it mean for them?
So typically, Pillar 2, because of its complexity, is dealt with by the ultimate parent company in the group. So the kind of challenge for an outbound is very different for an inbound. If we take the inbounds first, if you're a South African company and you're a subsidiary of a foreign group that qualifies for Pillar 2, 9 times out of 10, Pillar 2 will be driven by your parent company. So you will have to deal with whether there's a Pillar 2 exposure for your company in South Africa, but typically you won't have to worry about the rest of the group. And most of the time you'll get guidance from your group parent company as to what to do. The outbounds, on the other hand, have a much bigger challenge. So if you're a South African outbound group and you've got a parent company in South Africa, you've got to effectively take control of determining your potential Pillar 2 exposure for the whole group. And the challenge with that is that Pillar 2 will be implemented through domestic legislation across a number of different countries. And there are different types of Pillar 2 legislation. But in essence, as a South African outbound, you've got to look out for 2 different types of legislation. There's a domestic version called a QDMTT, or Qualified Domestic Minimum Top-Up Tax, which, if applied in a jurisdiction, takes precedence over the other forms of the legislation. So your first thing you need to do as a South African outbound is understand where there's a QDMTT where you operate globally. Where there is one, you'll need to fill out complete a return, and you'll need to do the calculations. And if there's a top-up tax, you pay that top-up tax in that country. On top of that, South Africa has also introduced what's called the IIR, the Income Inclusion Rule, which is formulated similar to kind of controlled foreign tax legislation, in the sense that it's a top-down piece of legislation. And what the IIR says in South Africa is that you, as the South African parent, need to calculate your Pillar 2 exposure in all your foreign jurisdictions that don't have the domestic version of the legislation, and then do a return in South Africa and pay the top-up tax in South Africa. So the challenge as an outbound is to understand what legislation applies when, and then determine your compliance burden, and to determine your potential top-up tax on that basis. But it'll be a combination, and more likely than not, it'll change over time as more and more countries start to implement the domestic version of the legislation.
Okay, and then for the inbound, you said that it typically is looked at sort of the host country, or the ultimate parent entity jurisdiction. What's from an SA point of view, if I'm a subsidiary of a multinational and I'm sitting here in South Africa, so I'm an inbound group, what do I need to be aware of? Do I just sort of leave it all up to my head office, or what do I need to know about?
Look, most of the time the head office will be driving the calculations, and the reasons for that are, as I said earlier, the complexity of the legislation. It sits somewhere between accounting and tax. It's very, very complicated. Most groups won't have the resources in their various subsidiary companies to do the calculations themselves. But second of all, the Pillar 2 legislation does require a degree of sort of global oversight, because the calculations are jurisdictional. So as I said, most of the time we find that the calculations and the process are driven centrally. What you would do, what I would suggest you do as part of a South African member of a multinational, is in the first instance get in touch with your parent company, find out what they're doing and what they need from you. The South African domestic version of the legislation is what would apply to you. That largely follows the OECD rules, but there are one or two specific nuances. More likely than not, your foreign parent company will want to know what those are. And then, typically you'd follow the guidance of the foreign parent company. But if not, you'd need to do the same calculations as we've spoken about previously. And regardless of who's driving the process, at the end of the day, you'll have to submit a return in South Africa, which you'll be responsible for.
Okay. Look, we're obviously talking very high level in this discussion, and there's a huge amount of detail. And that when you get into the detail and start doing the calculations and looking at the interim measures and the safe harbors, and that it gets very technical and complicated. What would you say are the key challenges from your perspective?
So I'll talk mostly from the perspective of the outbounds for the reasons we've discussed earlier, because there's more for them to deal with. I think the key challenges are probably the following. The first one is keeping up to date with the legislation, as we spoke about earlier. That requires an understanding of what legislation is impacted in what foreign jurisdictions you operate, what legislation takes precedence over other legislation, how it all interacts. That's a challenge in itself. Second of all, the resource challenge. We spoke about the complexity of the legislation. It's a tall order for most groups to skill up sufficiently that they are able to understand the legislation across all the different countries. Remember that the legislation has the status of a common standard, which means that a country doesn't need to adopt it, but if it does adopt it, it has to largely follow the OECD rules. But what we're seeing with the domestic versions of the legislation is that there are quite a lot of nuances that are creeping in and differences. So if you, the South African tax person with an outbound group, you're going to have to understand all the different nuances between the legislation in all the different countries. And that's a challenge in and of itself. Obviously, there's a potential impact on your effective tax rate. We've seen groups start to take, the Pillar 2 15% rate into account in investment decisions. But lastly, and probably most importantly, the biggest challenge is the compliance and the data burden that is associated with Pillar 2. We'll speak about safe harbors a little bit later, which gives you an out to some extent. But absent the application of the safe harbors, in order to complete your Pillar 2 return, you'll need to access about 220 data points, which are not all readily available. And the complexity of the return is quite significant. So almost the biggest challenge is for a group to be able to get their head around how they're going to get that data and how they're going to comply and submit the required returns.
I mean, that's a good point, because it's all very well for revenues to say, oh, fill in these forms, put this data in this format. Just getting the data when you've got a complex group with a lot of detail there, and your ERP systems aren't really set up to provide this, just getting the data to start is difficult. Okay, so this is all quite overwhelming. How do you start? How do you address this?
So we spoke about the safe harbors just now. What the OECD has done is they've recognized that, look, to get 220 data points across every country that you operate in where your rate is clearly above 15% doesn't make any sense. So what they've done is they've introduced some temporary safe harbors, which effectively say that if you meet the safe harbor in any jurisdiction for any year, then your globe income is null, so there's no adjustment to your taxes. And almost more importantly, your return that you need to submit is very abridged, and you don't need to go and get those 220 data points. You can simply rely on country by country reporting profit before tax and your income tax line from your financial statements with one or two adjustments. So what we are seeing is the best way to get your head around your potential Pillar 2 exposure, and what you need to do is start off with a safe harbor impact assessment. That then allows you to say, right, I operate in 12 different jurisdictions. I qualify for the safe harbor in 8 of those jurisdictions. So let me now focus on doing the detailed calculations for the other 4 jurisdictions and think about the data that I need to get. And we found that that is really an efficient way of really sort of breaking down the Pillar 2 challenge into bite-sized chunks. Ultimately, what you need to do is a kind of range of sort of phases, if you like, that will start with identifying who your constituent entities are and which ones are subject to the legislation in the various countries, then kind of working out to what extent you can rely on the safe harbors, then to the extent you can't, crunching those detailed calculations and thinking about how you get the data, and then doing all of that again for financial reporting purposes. So when the legislation kicks in your first year of operations, you're going to have to disclose your Pillar 2 exposure in your financial statements. So thinking about how you're going to get that data to do those calculations in time to have an accurate disclosure will be a challenge in and of itself. And then finally, the whole process will end with obviously submitting completing your returns and submitting them. But as I said at the beginning, while all of that is fairly daunting, we're finding that if you start with a safe harbor impact assessment, understand where you are after that, and then kind of agree on a course of action, we find that it does break down the whole challenge into bite-sized chunks.
Okay, so yeah, that makes sense. So really a key thing, and it's interesting how it all ties into transfer pricing as well, conceptually, because in transfer pricing, one of the big issues is getting the data. What are the actual facts that you do a functional analysis? And that's often the hardest part of the whole thing, is find out what's really going on in very big, complex groups. So, I mean, the start of all this is the data. And you've then got to, with that data, you've got to do a CBCR, country by country report. And that's the starting point to get the data to start crunching all these numbers. So that means your CBCR report is a lot more important than it was in the past, because previously, big groups had to do these reports, but it was really just a data dump, a set of information to give to the revenues, which they could then analyze. Now, it means directly using their data to calculate taxes due and top up taxes and that. So there's a lot more focus on getting this data and getting it right. Cornelie, I mean, you've been working with CBCRs for a number of years. Talk to me a little bit about what we've been saying now.
Thank you, Michael. Michael, as you correctly pointed out, the big problem historically has been that we haven't seen much traction from a revenue authority perspective with regard to actually interrogating CBCRs. And that's definitely something that's very much due to change. And there's even some people suggesting that that revenue authorities will start to actually almost look at and almost audit CBCRs going forward, given that the CBCR data and some of the selected data points under there is your key inputs for your safe harbors, which William mentioned earlier. So you need to look at, for example, items like income, profit before tax, etc. You need to figure out if there are any adjustments that you need to make to those. And also the key thing through all of this is that you need to have qualified CBCR based on qualifying financial statements, which at the end of the day will be the starting point. Now, what's key there is an initial step to understand will be to say, how do I get myself to a qualifying CBCR based off qualifying financial statements? Now, that means your financial statements themselves need to be qualified, i.e. in terms of the relevant, it's financial statements prepared in terms of the relevant accounting standards, IFRS, US GAAP, etc. And then from there on saying, okay, I now need to follow my CBCR process. And then thinking about, remember the OECD initially brought out guidance on CBCR, they then later brought out guidance as well. Am I applying that latest guidance in my calculations? For example, how are my things being disclosed in my financial statements? And then really pulling that through and making sure that your CBCR process is as robust as possible. One of the key things from a TP perspective in there that becomes an issue is because you're working off qualified financial statements. If you're going to have transfer pricing adjustments, outside your financial statements, that's going to cause an issue for you on the safe harbor, because you're supposed to, for the qualifying CBCR, work off these financials. So there's also a TP aspect to this that would need to be considered to ensure that you can ultimately rely on that exemption. So there's some work that needs to be done around your CBCR, your process, how are you putting it all together, where are you getting everything from, are you applying the latest guidance and definitions in determining that? And then once you've got that, then you've got the data to then go towards saying, okay, let's now calculate the different exemptions. Can I apply those exemptions? Because the other problem is also if you don't have a qualifying CBCR in terms of the rules. So the problem is then if in year one you don't have a qualifying CBCR, you don't have the option in year two to go back to that. You ultimately then will fall out of the exemptions, and then you're into the massive data gathering exercise, and then you need to apply the whole thing. So it's actually really important for people to ensure that where they can, they try and utilize these exemptions.
Okay, so if you don't meet the requirements, then you're out of the safe harbors, which is that interim measure. Okay, so that's important to know. You just because you got a CBCR, you should do a gap analysis to check, is it a qualifying CBCR, so all the right definitions are met, etc. The other thing, I was talking to some of my colleagues overseas who really getting stuck into this because it's quite difficult to get all the data. And one of the things they were saying as well is they were saying that transfer pricing is at the heart of all of this. And obviously I've got to plug that a bit because this is a TP Matters podcast. But one of the factors is that all the transactions that go into your qualifying CBCR should be at arm's length. If something's not arm's length, then it can taint the calculations. So it's important to make sure that, be it from a preparation point of view or an auditing of the qualifying CBCR and working out if you've got a domestic top-up tax due, you've got to be able to say that, yes, the transfer pricing is right. Because if that's not right, then your CBCR data is wrong, and then all your analyses are wrong. So transfer pricing and CBCR is becoming more important than ever.
And Michael, further to that, the other thing that's important, obviously these safe harbors will only apply for a transitional period. After that, we're into all the normal sort of data gathering points. And even there is quite an important TP touch point, is that in order to run your data, let's say for year-end provisioning purposes, you need to already have run your TP and it needs to be in your books. And quite often clients struggle to get the TP calculations done quickly post year-end. So there's a very big focus on getting the TP done sooner and quicker. And that's why operational transfer pricing is sort of gaining prominence, to try and get those adjustments within your financial statements in time. So you've got time to do all these calculations, definitely for audit and provisioning purposes, and then for your final reporting as well.
Okay, so getting all those data points is tricky. William, any comments on that aspect?
Maybe just to make a broader comment that we're having quite a lot of discussions around, if you're an SA outbound now, you're going to have to, after the first year that this comes in, you're going to have to do your country by country report. You're going to have to think about your CFC filings. You're going to have to do your income tax return. Now you're going to have to do your Pillar 2 return as well. So there's, we're having discussions around how you get all of that data in an efficient way. So get data once, use it, for example, get your CBC data, use that then to feed into the other processes. And similarly, on the other side, there's an aspect to connecting all of your compliance on the other end. So they have slightly different filing obligations. So your country by country reporting, your CFC returns, etc., typically within the first year of your year of assessment. Pillar 2 returns are only due 18 months after the year of assessment, but you don't want to miss a trick and have a Pillar 2 top-up tax that you wanted to claim, for example, as a 6-quat credit, and then you realize you've already submitted your income tax return. So there's quite a sort of coordinated angle to getting the data and at the other end of the process to ensuring that all the returns are filed in the right way.
Mm. It's interesting from a transfer pricing point of view. One of the big things internationally is something called transactional transfer pricing. And what that talks to is getting almost real-time data. So getting your systems talking to your transfer pricing policies so you can get data contemporaneously. You can make adjustments so you can meet your margins. This thing of having your TP documents filled in 5 years after year end and then realizing, oops, it doesn't quite meet the criteria and you've got a TP adjustment. All of that is going to be much more of a mess if you try and do it now. So I think systems and ultimately, I suppose, AI to help doing all of this, but that's at this stage probably a bit more of a pipe dream than we would like, but eventually that'll come. But getting all of this stuff to get real-time data so that it doesn't lag so long is going to be useful.
Michael, the other important point which William may want to comment on is it's my understanding that once you've paid that top-up tax and you've found that you've overpaid that, you may not be able to claim a refund for that overpayment. William, any comments on that?
There are some rules around that are fairly complicated. There are instances when you can claim it back, but absolutely, you don't want to be in that position if you can help it.
Yeah, as soon as you've got different governments fighting about money, it's a mess. So you want to avoid that at all costs. Practically, what do people need to do now?
Well, I think it's what we said. I think you need to start with an impact assessment as soon as possible. I mean, look, Pillar 2 is potential additional tax, it's additional compliance, it's an additional burden on companies, and it's daunting when you look at it in totality, but it doesn't have to be daunting. It's very case specific. If you qualify for the safe harbors in all the jurisdictions you operate, it's not such a big deal. There are things you have to do, like making sure your CBCR is qualifying, etc. But it's a very different proposition to a group that would have 10 jurisdictions where they need to do the detailed calculations and get the detailed information. So start as soon as possible and understand by doing an impact assessment what the size of the challenge is, and don't leave it too late. It is manageable, but given the 1 January implementation date from South Africa, it's urgent that you start now.
Yeah, and I mean, a practical thing that I've encountered with some of my clients is people thought, oh, tax rate is high in that country, it'll be fine. The tax rate's 25, 30%. There's no ways we'll get, we won't meet a 15% threshold. And generally that's true. But when you're dealing with a whole bunch of countries, every now and again there's an anomaly for whatever local accounting reason for different tax treatments. People consistently have said to me, they came up with this result in this country and they didn't meet the 15%, and they were flabbergasted about it. So don't just assume because there's a high tax rate that you'll be fine, because every now and again there's an anomaly and you get nailed. Okay, wrap up comments, anybody?
I think we've said it all. It's I think we've said it all. Start as soon as you can is my guidance.
Yeah,
the legislation's here. This isn't something that's coming down the road. It's already here. It's a big deal internationally, and you need to get it right. Okay, everybody, thanks very much, William and Cornelie, for being on our podcast. And we will maybe cover a different pillar in a different architectural episode of transfer pricing. Cheers.
All rights reserved. PwC refers to the South African member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes and should not be used as a substitute for consultation with professional advisors.